Hey everybody, good morning. I wanted to make this video because there's a number of people that are doing IAs, or maybe you need to revisit this because it's kind of a tricky topic. I think it's super important for you to understand that with this, especially, you should try to run through this at the same time. So your study guide, you're going to notice it's a bit more extensive, and there's a bunch of HL only in here. Um, there's a bunch of math, so there will be some days where the SLs you don't have to necessarily show up to class, but conceptually you're still going to need to do stuff. So let's get started on this balance of payment. So balance of payment is part of international economics, and it has a bit to do with exchange rates amongst other things. But essentially, it's the inflow and outflow of money to countries, uh, and that's it. So it's BOP, balance of payments, credits and debits of a nation will balance in the end. That's the idea. Um, so the structure of an economy is essential to ensure a stable balance of payment. So some misconceptions that countries should have positive trade balance. Money should flow into uh, a country because of strong qualities of the country, not exploitation. FDI. We'll talk about that. FDI. But basically, um, just understand that there are misconceptions about balance of payment. Most notably, like I said, that your trade balance should be positive. It doesn't need to be in order for you to have a balance of payment. And the same thing should be said about money flowing into countries. Um, we know that money can flow into countries regardless of whether it's because of the positive or strong qualities of the country. So just so you're aware of the definition, so you can go straight to your study guide if you want. The balance of payment is the record of the value of all transactions between the residents of one country and the residents of all other countries in the world over a given period of time. And it's compartmentalized into three different components. There is the current account, the capital account, and the financial account. We'll talk about what all those things are. Here is a visual kind of how all this looks. If you look at the current account, you have three different brackets within that: goods and services, income, and current transfers. Exports, imports, inflows, outflows, inflows, outflows. This is the financial account, investments, right? So there's direct investment and then there's portfolio investments. There's the capital account, which is just capital transferred from one country or into a country and then out of a country. Underneath all that is the official reserves. If current account plus financial account plus capital account are greater than zero, official reserves rise. And so on. You can get the other side. So current account plus financial account plus capital account plus change in reserves equals zero. So there are four components with multiple components within the components. Hence, you can see why this can be a very confusing concept to students and why I'm going to try to go through this incrementally over time. So just a couple of tidbits that are important to try to remember, all right? Some more definitions, if you will. When money leaves a country, it's called a debit. Let me repeat that. When money leaves a country, it's called a debit. Investments, imports, aid to other countries, purchase of foreign business, so on. On the opposite, when money is coming into a country, it is called credit, or it is a credit. All right, so try to get rid of your conceptions of debit and credit from your own personal banking, all right, experiences. This is a totally different thing. So if you could make a connection, you're more than welcome to try to remember this stuff. But just remember, debit is when something leaves, and a credit is when something comes back. So purchase of assets, businesses, property, and domestically produced goods by people in other places is a credit. An important note here also, the balance of payment has to do with money exchanges between countries. It does not have to do with physical goods and services entering or leaving a country. When a good is imported, it's recorded as a debit because money leaves the country, even though the physical item comes into the country. All right, so read that back again if you have some confusion. But just remember, it only has to do with the money. All right, so balance of payments is only the money exchange. So the last thing I want to get into for this part, I want to talk about the current account. I'm not going to go further than that today because I don't want to confuse anybody or overdo it. But the current account is a measure. It basically measures the balance of trade in goods and services and the flow of income between a nation and all other nations. That's a lot of this is going to be like convoluted sounding. If you watch a Welker video too on this, which I will link, and also there's a link in this presentation, he essentially says the same thing. I think he even may say the word convoluted, and it's the best way to describe it, right? It's you have to like kind of cut between the lines. What is this really saying? So, what the current account does essentially, or what it is most frequently discussed because of the large trade volumes around the world. So, the current account, I want to call it the most important account of the balance of payments, but it is probably the most emphasized. It records monetary gifts or grants. Many countries that have difficulties with balance of payment have them in this account. There are four components. There's the flow of goods, the flow of services, the flow of income, and the flow of transfers. Hence why I'm going to stop after we go through the current account. So, four components. First, balance of trade in goods. This is a visible balance. Tangible goods being traded between countries. Spending by consumers and firms. When a country imports, the import expenditure leaves the country, recorded as debit on current account. What does debit mean, you ask again? It's when money leaves a country. When a country exports money, it enters the country, recorded as credit. And remember, that's the opposite. So you're actually receiving, right? You're not losing necessarily. Hopefully this makes sense. Please reread any of these if you need to, right? Balance of trade and services. Now, remember, we're still in current account, right? And you have a balance in trade and services. This is an invisible balance consisting of a balance of trade, of legal services, hospitality, consultancy, and so on. The sector is a major earner for developed nations for a number of reasons. Move away from primary and secondary industries towards tertiary industries to generate large amounts of surplus value. So this is the developing nations thing, right? Service economies, right? You're doing things for people. It's that in the middle type of stuff. You act as a liaison, right? Consultancy, hospitality, legal services. The third part of current account is income transfer. So this refers to factor payments for the factors of production. Factor payments for the factor of production. Own property in another country. Receive rent that is credited to the current account of the country you live in. Dividend payments when you own shares of a company. Refers to the income derived from owning that asset, not the purchase of that asset, aka earning interest on bonds. So when if you buy another country's bonds, which you can do on the open market, you're doing that, right? It's part of that income transfer. The other way you can think about this too is like literally in the income transfer. Say you work in a different country, like if I worked in Germany and some of my money went back to a bank in the United States, it's got that vibe. Finally, current transfers, and this is the IMF, the International Monetary Fund definition. We'll look into a little bit about what the IMF really does, but you should at least know the name. Those general governments, current international cooperation between different governments, payments of current taxes on income and wealth, etc., and other transfers. So let me go back. Current transfers. Those of general governments and other transfers. What does that mean? Okay. When you define the current account in an exam, it is important that you include all four components, not just the balance of trade, or you will lose marks. Sum of four components of current accounts is negative. Sum of four is so you equals deficit. Sum of four components is positive. You have a surplus. So surplus and deficit on your balance of payments. And so if you think about if you just think about everything that we've learned, you start to see repeats of terms, and it's super, super important that you say what it is in reference to. So you can't just say surplus anymore, right? Now we're adding to that. You have to refer to whether it's a surplus in your budget. So when we talk about fiscal policy, right? A surplus in your fiscal policy doesn't mean a surplus in your balance of payment. So like I said, you need to go back through and you need to make sure that you're very, very careful with the way you word things, okay? We're going to get into the capital account tomorrow, but that is generally the gist of what I wanted to talk about today. Like I said, as we go through this, the capital account, the portfolio, so on and so forth, we'll talk about the relationship between those accounts, and we're going to get into some math, all right? Yeah, boom. So being able to do this stuff is definitely an HL topic. We're going to talk about current account deficits. There is a lot to unpack with this. It's going to take time and it's going to be confusing. So I just want to reiterate to you that you just need to kind of make sure your language is clear. This is a section where it is super important for you to read the Cognitive sections, and it is super important for you to do the study guide very seriously and thoroughly. I would also say that I'm going to give you as much practice with the math as possible because, like I said, we're going to review this at the end of the year before your exams, but the majority of you guys take, well, the vast majority, like 99% of you take HL, so it is going to be one of those things that may not be avoidable for you on your exam. So it's important that you understand the concept very thoroughly. Anyway, that is all for now.